everyone, welcome to Wharton Tech Talks. I'm your host, Manasi. Today we're joined by an incredibly exciting guest, Mitchell Green. Mitchell Green is the founding and managing partner of LeadEdge Capital, a $5 billion growth stage investment firm that specializes in supporting portfolio companies via its extensive investor network that's comprised of more than 700 individual LPs. Mitchell oversees the firm's software, internet, and tech-enabled services investments globally, and also led early-stage investments in a wide range of portfolio companies, including Alibaba Group, Spotify, Asana, Uber, Toast, and Bumble. Prior to founding LeadEdge Capital, Mitchell was on the investment teams at Eastern Advisors and Bessemer Venture Partners. Mitchell is a fellow Wharton alum with an MBA in marketing here from Wharton and holds a BA in economics from Williams. Mitchell is also a formerly nationally ranked alpine ski racer. Thanks so much for joining us today.
Thanks so much for having me.
Well, to get started, prior to business school, you were at Bessemer. We have quite a few listeners, both students, alumni, and beyond, who are interested in investing careers. Could you share a little bit about your start in investing and what drove your interest there?
Sure. Look, thanks so much for having me on. My start in investing started off with a grandfather who's got me into reading the Wall Street Journal as a 8-year-old or 10-year-old. And my grandfather ran the municipal bond department at Paine Webber for many, many years, which is now UBS to many listeners. So I'd always been interested in investing. After I graduated from Williams, which I really only got into because I could ski race down the hill fast, I ended up going to UBS Investment Bank, where I spent a year making PowerPoint presentations at 3 a.m, as I'm sure a lot of people in your business school class, my class at Wharton definitely had done. I then joined Bessemer Venture Partners, which was a world-class venture fund. And I effectively had an apprenticeship. And I was able to, for 2 years, they handed me a telephone and a computer where I met my now partner, Brian. And we were the first 2 analysts they had ever had. And they said, go cold call companies all day long. And when I took the job, my dad said to me, oh, you're one of these idiots. My dad ran a manufacturing business that would constantly have private equity people cold calling. And he figured out, he's like, listen, you better figure out how to add value. Or you kind of just look like everybody else. I ended up doing that for a couple of years, learned a ton at Bessemer about investing and would connect entrepreneurs to one another that should know each other in my cold calling. And you know how you figure out what a good company is? Talk to, 10,000 bad companies. Between 2005 to 2007, my now partner Brian and I left 20,000 voicemails at an era when people left voicemails, sent 10,000 emails, spoke to probably 6,000 entrepreneurs. And off our backs, they put 30 term sheets, did 10 deals. And these are some great companies. One of the companies was a company called diapers.com, which was a very big business and was bought by Walmart. LifeLock was another one that my partner Brian, we ran us together, sourced. After Bessemer, I went to Wharton Business School. And at Wharton, I started working for a hedge fund during my first year that was under the Julian Robertson umbrella. Funny story. I learned that in the middle of February or January, there was like a 2-week break for internships. You didn't have to go to school. So to me, that was like, I can go ski for 2 weeks. I ended up getting a job offer actually in like November or December. So I got to ski for 2 weeks. But then I actually went right to start working for that hedge fund. And I actually worked all the way through business school. This is like 08, 09 timeframe, and worked the entire way, and then worked in my second year. I actually could have just not come back for my second year, but I worked the entire time and got paid full time to go to school and worked for a hedge fund. And that was the hedge fund that I eventually would spin LeadEdge out. While I was there in May of 08, which would have been my first year of business school, I made an investment in a private company. This hedge fund mainly did public stuff, did a little bit of private. And I ended up making an investment in a company that was a software company called Bizarre Voice, run by a guy named Brett Hurt. Funny enough, that entrepreneur, he went to Wharton as well, business school. And I ended up making that investment. And that was the start of LeadEdge, effectively. And I made that investment at the hedge fund called Eastern Advisors. The hedge fund then, after all of 08, kind of was down like 50%. And I was able to buy the investment out of the hedge fund and partnered with the founder of the hedge fund and did an SPV. And I basically raised the money from anybody who, one, I thought had rich parents at my business school at Wharton class, or two, like any successful entrepreneurs I had cold called. So I used persistence to find a bunch of investors, raise the capital, did a couple SPVs after that. And then in 2011, we raised our first $50 million fund. And 6 funds later, we're investing out of Fund 6 at $2 billion. So that's very fortunate to have a team. Started with just myself. Now we have, I don't know, nearly 75 people, and life is good. And God bless a bull market as well. That's probably the most important thing. So
Absolutely. Really interesting story. And going back a little bit to your time at Bessemer, just because it was an interesting time period, I think 2005 to 2007. So right before the Great Recession really kicked off. Assuming you were kind of focused on tech there too, curious kind of how the market looked from the perspective of being a sourcer, doing cold outreach, and really seeing how valuations and company willingness for deals had changed during your time there.
yeah, so cold calling is nothing new. TA Associates and Summit Partners literally invented this 40 years ago. Look, the good companies don't call you back right away. You got to call them every 2 days for a month. That's the CEO you want to get on the phone. No different than if you work at Morgan Stanley or Goldman Sachs in private wealth management and they're calling you, you're calling rich people. The guy who's actually rich or gal who's rich doesn't actually call you back. It takes you 10 times calling them or emailing them every 2 days. It's persistence. That's who calls you back. Those are the companies you want to talk to. Those are the people you want to talk to. It works. It's the same way we source today. We have nearly 20 associates and analysts that pound the phones doing the exact same job. And it's the best job you can do out of undergrad, I'd argue, if you want to be an investor, because you only know what's good by talking to thousands of bad companies. In terms of valuations, a lot cheaper then than it was now. Remember, I was calling software and internet companies, but the SaaS business model was just kind of like people were just starting to understand it. I remember doing deals like at 3 times ARR, 4 times ARR in companies growing 50, 100+% a year. Now, again, why did investors make so much money over time? These companies grew a lot and multiples expanded a lot. Go look at like the seed round of a company like HubSpot or Viva or Salesforce. So these things were done at basically nothing. And not only did they get enormous amounts of growth, they also got enormous amounts of multiple expansion as well.
Yeah, absolutely. Makes a lot of sense. And you kind of talked through the process of starting Lead Edge and what led up to that. What was the hardest part of getting that started? I know getting LPs, of course, requires a lot of persistence, dedication.
Getting LPs. You answered the question yourself. Getting the LPs. That I was 27 years old with no track record. In my first SPV that I was just invested in this company, Bizarre Voice, I had to go convince people not only was I not going to steal all their money, I was actually investing in this company and this company was a good company. And then after doing a couple of SPVs, I had to convince people at 29 years old just to give me $50 million to raise a fund. People were like, you guys are nuts. Oh, wait a second. Your first investment is going to be a company in China, Alibaba Group? What? China? And by the way, 2 days before we closed the fund, Jack Ma took Alipay out of Alibaba Group. What? Like, are you crazy? I mean, we ended up making a great return on Alibaba, but a phenomenal return in terms of just like getting LPs, by far the hardest thing. Nothing else even comes close.
Definitely. And LeadEdge has kind of a unique LP base from what I understand. When acquiring them, reaching out to them at the fund's inception, what was the pitch? Because as you mentioned, maybe less track record, but was it kind of having this very specific criteria, ideas on what the next company, what the next investment might look like, or the team that you were planning on building?
The LPs were our pitch to LPs was really simple. Invest in our fund. We're going to run around the world and find companies that meet our very specific criteria. Today we have 8 criteria. Back then they were 6. Just a couple have been expanded upon. And these are like, I get 10 million plus in revenue. Are you growing 25% plus a year? Do you have like 75% gross margins? Do you have any customer concentration? Are you profitable? Do you have like 90+% gross dollar retention? Are you capital efficient? Are your revenues greater than the amount of money you've burned since inception? The world is littered with $20 million revenue companies that have burned 80 million bucks. You're only efficient if you've burned less than 20 million bucks to get to 20 in revenue. And to call 8,000 companies, you might find 1% a year that meet all 8 criteria. So you're looking for like 5 or more of these criteria. We said, look, we're going to run around the world, find companies that meet 4 to 5 of the 6 criteria. When we find them, we're going to leverage you guys and gals to help us. You can help us do diligence. You can help the company make customer intros. You can help with helping us find recruiting, CFO, head of audit chair, head of HR, whatever. But let us do the looking and then you help. That was the pitch. No different than if I had been the global head of HR at American Express and you were the global head of HR at Pepsi and our friend was the global head of HR at Microsoft and our other friend was the head of HR at Procter & Gamble. Imagine if we had showed up when Workday was 20 million in revenue and said, hey, let us invest and we'll introduce you to all our friends who can buy your software, heads of HR. A lot easier to sell down than it is to sell up. That was our pitch. But since we had never run anything in our life, we were like, look, let's have our LPs be our competitive weapon. And today, that is what differentiates us. That is what really differentiates us in the market.
Definitely. And when LPs get involved with portfolio companies, can definitely see the approach to value creation that helps set LeadEdge apart. Are there domains that you're noticing have always been top of mind for Portco? So whether it's challenges with getting a go-to-market function off the ground or something like add-on M&A or building out a C-suite, are there a couple of common issues you've seen them be most valuable for?
Oh, and there's like thousands. We track all of these. How about revenues? We have a company called Live View Technologies that sells outdoor camera systems. If you go to like a Walmart parking lot and not a great area of town, you might see looks like a construction trailer with like blue flashing lights at night. It's actually an outdoor camera system. That's a business that we've grown into nearly hundreds. It's not far away from 200 million in revenue, growing nearly 100% a year. And they wanted an introduction to 7-Eleven because they thought it could be, a lot of 7-Elevens are in dangerous areas. Well, it's now a multi-million-dollar customer. We just helped them get to the right person at the company. Lots of examples like that. Or in the case of like Asana, they were looking for like a female audit chair. We emailed all of our LPs and got like 60 suggestions on women that would make like great audit chairs. We helped them place their audit chair off that list. Yeah, even had hired a recruiter and we found the audit chair. So there's like thousands of examples like that.
For sure. And then switching a bit to LeadEdge's investment criteria, I know you mentioned there were maybe 5 or 6 when you started. It's expanded to 8, and a couple of things kind of on top line revenue margins, but also the business model and customer base. You have this overarching theme of SaaS or highly recurring businesses. How has your perspective been on being generalist in the SaaS space versus kind of taking a verticalized approach to sourcing and deciding which areas you're excited about?
We use a Moneyball approach to invest in. We're like extremely clear on it too. And where there's smoke, there's fire. We have a team of 20 associates that are calling 8,000 companies a year. And if they call an interesting software company that meets 7 of our 8 criteria, and it so happens to be in the restaurant point of sale system space like Toast was in 2015, which we first started calling in 13, because there's no database that exists of these companies. Like we're trying to extract information out of the CEO. Well, guess what? You don't only call Toast, you call every competitor that competes with Toast because you know Toast is growing well. And then, by the way, when you do the work, if one comes into diligence, you then hire a consulting firm like Bain or McKinsey or LEK or something like that to go do a market study. And you talk to all the competitors and you use your LPs to talk to tons of customers. You just build up like a synopsis of what's going on. There are, of course, things that they're over time talking to tens and thousands of companies, hundreds of thousands we've probably spoken to since inception. Our domains of expertise. We've done some security investments. We've done stuff around developer tools, infrastructure software, vertical application software, compliance software, internet marketplaces, payments businesses, managed services businesses, business process outsourcing, information services businesses. There are definitely areas, subject areas, sub verticals of software. But again, we take a Moneyball approach. It's like call companies all day long and figure out where there's smoke, there's fire. Pontificating doesn't get you very far. Action does.
Sure.
We think there's way too many people in this industry that pontificate.
We talked about this at the beginning, how ultimately, in some ways, you want to be able to preempt a deal, right? And that's why you identify a great company, you get that relationship going. Ideally, it becomes actionable. Looking at the criteria, I assume that there are a lot of firms with similar criteria and they might be reaching out to these same companies. Once you engage with them, what's LeadEdge's pitch for either preempting a process, getting a deal done versus a competitor firm, whether it's kind of the portfolio value, the LP value, or something else?
Let's say you ran a $20 million software company growing 80% a year that makes software for biotech and pharmaceutical labs. Benchling would be a perfect example of when we were an early investor in. It was like 13 million of revenue. We'd say that we're like, okay, we'd do the analysis. We'd talk to the company. They'd share information. We're like, okay, it's 13 of ARR, growing crazy fast, 160 net dollar retention, 97% gross dollar retention, no customer concentration, not burning hardly any money. Spent $5 million to add 8 of ARR annual recurring ARR last year. That's a good business. Okay, well, what the heck do we know about biotech and pharmaceutical software? Not a lot. So we say to the CEO, oh, you want to meet the former CEO of Biogen? You want to meet the former CEO of Pfizer? I saw that J&J is a small customer. Could it be big? Oh, it could be millions. Want to meet somebody who's been on the board for 15 years? And then we call those people up and they're like, oh, a good CEO would be like, absolutely, yes. And then we call the CEO up, or those people up, and we're like, hey, we tell this company, it like meets all these criteria. Will you like do a call with them? We'd love to know what you think. Because you know more about this than we're ever going to know, this sector. And it helps us win the deal. That's how we preempt. We get LPs engaged.
Great. Switching a bit to kind of areas you might be excited about. I know you've chatted a little bit about kind of China's tech sector, as well as some second layer impacts you might see of AI. Are there any domains, whether it's kind of international areas or sub themes within software, that you're lasered in on right now?
I could blow smoke up you and be like, oh, we're super interested in like developer tool software or like AI. AI is going to change the world, by the way. 95% of these companies being backed are going to be zeros. A partner at one of the best firms on the planet told me, actually, the best private venture firm on the planet told me, in 1997, if you wanted to build a website, what would you do? You go to Sun Microsystems, you spend $50 million on servers, and you'd have a website. You know how you build a website now? Costs you $20 and you go with your credit card to GoDaddy. Same thing's going to happen in AI. It's going to change the world. It's going to have profound impacts. We think it's going to take 5 to 10 years. Remember when everybody said they were going to be self-driving cars? I had so many people tell me Uber was going to be destroyed because of self-driving cars. Still drive my car to the office every day, unfortunately. And I probably will be again in 5 to 10 years. It's like the 1% that gets really hard. We try not to pontificate. We try to just call companies all day long and finding stuff. So like, where are we finding opportunities right now? Companies that are like, we just recently invested in a storage business. We recently invested in a company that makes like software for Chamber of Commerce organizations. We recently invested we're looking at something in the DevOps space. We recently invested in something that makes software around the Snowflake, like it's a tech-enabled services business is around like the Snowflake ecosystem. But again, like it's software. We have a thesis that software is eating the world, and we're still in the early innings of software making the world a much more productive place. I'm also like, I think China's probably pretty interesting right now. I think like ByteDance is a phenomenal business that you can buy crazy cheap. 2 years ago, you could buy ByteDance for 180 billion and call it 200 billion, and Facebook was worth 300 billion. Fast forward a couple of years to today, ByteDance is 220, 240 billion. Facebook is 1.2, 1.3 trillion. I mean, you see the numbers that have kind of leaked on ByteDance. It's the same size as Facebook, growing 3x faster at 5 times earnings. That's crazy. Now, I don't know what's going to happen in China over the next week. I do know this, that some of the smartest investors on the planet have told me that if you do the opposite of what all great public investors do, if the crowd is always wrong, if you ask 10 people what the market's going to do and 9 say one thing and 1 says the other thing, and you do that 10 times, if you do always what the one person said, you'll make a lot of money. Right now, China's as hated as it's ever been. I don't know if it's going to turn around, but like seems like a pretty good bet at 5 times the earnings.
Yeah. Thanks for the insight on kind of what kinds of companies you're seeing and the deals you're interested in your pipeline. Thinking about your criteria, when your team gets on the phone with these companies to screen them, has any of the criteria changed, or are you indexing more on certain things over others? I think we hear a lot of the times that obviously you're going to be more focused on margins or kind of that path towards profitability and the viability that could actually happen. But curious how your perspective might have been.
When we first started Lead Edge, we had 6 criteria. Now we have 8 criteria. And the criteria are all like extremely, extremely similar. We added in capital efficiency as one, probably 5 or 6 years ago in a world where there was like too much money chasing too few good companies. A company that's burned a crazy amount of money to get, if you've burned 80 million to get to 20 million in revenue, like maybe you're a good company. You could be a great company. But if you got a company that's only burned 3 million to get to 20 million in revenue, growing 70% a year, that's a pretty good business. Now, again, it may not be as valuable in the long term as the business that burned 80, but you're less likely to run the business off a cliff with an entrepreneur that respects the value of a dollar. And an entrepreneur who's only burned 3 million to get to 20 million in revenue, I would argue values a dollar more than an entrepreneur that spent 80 million to get to 20 million in revenue. Now, again, maybe that company that's burned 80 though is in a space, it's a huge horizontal market and it makes sense to do it. And look, we've invested, not every company we invest in is capital efficient. It's just a way for us to think about like return on investment of a dollar invested. It's not a perfect measure. That was a new one. And then gross retention we added as well, just in terms of like making sure we screen for companies that have 90+% gross retention. And why does that matter? If you have 90% gross retention and you start your business of the year with 10 million of revenue, that means at the end of the year, you have 9 million of revenue. So like you literally had to go sell another $1 million of stuff to make up for the $1 million lost. Or let's say you only had 70%. So we want 90% plus, but let's say you had 70%. You need to get like 3 million then new if you're a $10 million revenue company. That's not that hard given it's not big numbers. Now fast forward to when you get 200 million of revenue. The problem is if you've only got 70% gross retention, you need to spend a bunch of money on sales and marketing to get $60 million new to just get back to flat. Versus if you had 90% retention, you only have to spend 20, which means you can spend a lot less on sales and marketing to go out. Like if your retention rates aren't high enough, you kind of run on a treadmill, if that makes sense.
Yeah, for sure. And are those words for certain end markets within software, right? So I can imagine maybe selling to school districts on the ed tech side, probably going to struggle a little bit with upsell or expansion piece. Maybe you're a little safer on the churn side. Maybe selling to large or mid-sized healthcare clients, maybe you do deal with some churn if they're treating this like pilot. So do you notice any major bifurcation based on the end?
Oh, yeah, for sure. SMB software, high gross churn, right? SMB companies go out of business. Selling marketing software. A lot of marketing software is not mission critical. So what happens is, and a lot of these people in these jobs are very young that buy the software. So like social media monitoring software. We were an investor in a company. We made a little bit of money. The churn sucked. We invested. It was pretty good. They got worse after as it grew. It sold to like 26-year-olds. 26-year-olds don't stay in their careers, don't stay in that job very long. They move to a different job. The new person then goes and gets the next shiny object, especially if it's not that hard to rip and replace it. We had companies that they like ripped and replaced it. Then a new person came in and they brought it back. So SMB software tends to be much higher churn. Healthcare, like selling to hospitals, tends to be hard to get the initial deal because they're just very big, complicated places. But once you sell to them, like good luck, you're never going to get ripped out. How you price versus is it price per seat? Is it price for usage? That can have massive impacts on net retention. So I think in an economy that's slower, companies are really looking and saying like, hey, you know what? We bought 100 seats. We really only need 50 seats. So that impacts net dollar retention in terms of like upsells and things like that.
Yep, really interesting. Looking through the portfolio, one company that I think would be of particular interest to our listeners is Toast. Would love to hear a little bit before it went public, which congratulations to LeadEdge and of course the Toast team. Would be curious to hear, how did you come across that one? Did it pan out kind of as you expected in regards to the uptake and kind of their growth strategy and so forth?
Yeah, look, we were early investors in it. We led one of the early rounds. We found it through cold calling and convinced them. And then we actually had emailed our LPs to ask them who owns restaurants. Turns out you should never email rich people to ask if they know people who own restaurants. Lots of rich people own restaurants. By the way, we started introducing to our LPs and some people were like, this is amazing. Can my restaurant use this software? The company loves it. They're getting customers. We love it. We're demonstrating value add. And we're also getting diligence. These guys won because they built a better product. It's just a great product. They then figured out how to upsell it. So it started with the software. If you think about like Micros or Aloha, which is owned by NCR, who they competed with, these guys made you buy $20,000 systems that were proprietary. The hardware was crap. Software was even crappier. And if you drop the system, you'd take you a month to get it replaced and $10,000. You break a Toast device, you go to Staples and buy a new one for $100 a tablet. They're going to rent you the software for a couple $100 a month. So there's not a lot of big upfront charge. Oh, by the way, once we get you on the software, we're going to basically say, listen, you got to use payment processing. And oh, by the way, we'll save you money. You don't have to process payments with Chase Payment Tech or one of the First Data. Use us. And oh, by the way, we're like Walmart now. We got tens of thousands of restaurants on the platform. And we can process payments. Like if you've got one little retail store, I can assure you that you pay Amex a lot more than Walmart does to take a credit card. They got like the purchasing power of the whole network. Then they were like, oh, well, what else do restaurants do? Oh, they do payroll. They got a huge number of restaurants. And so it's like ARPU. You get in as like the Trojan horse with one thing and then try to continue to upsell more and more of your customers. That's what Toast is really doing. And it's a really big market. It's a sneakier big market than people think. Because people are like, Micros was never that big inside Oracle. Yeah, because it only sold systems for 20 grand a pop. Now you're taking like different parts of the value chain and attributing them to one company. You're getting the payroll, you're getting the processing, you're getting the software, you're just giving the hardware away. There's a whole long line of list of things that they'll be doing over time.
Really, really interesting and will be super helpful to hear. We have a couple minutes left. Thank you so much for the insights. We always like to end with a couple of fun rapid fire questions. So to start, would love to hear if you have a favorite restaurant or bar in the Santa Barbara area.
I would be very, very biased if I don't say my wife's restaurant, which she partnered with a 1-star Michelin chef to build. Well, clearly, I'm the investor in it as well. So Silver's Omakase, the chef is a tattooed up white guy named Lennon Lee. He won a Michelin star at the Montecito sushi bar. My wife didn't like that he was getting paid basically nothing. So she convinced him. She said, I'll build a restaurant for you. You own half, we own half. And they've like absolutely crushed it out of the gate the first like 3 or 4 months. I love sushi though. If you don't like sushi, Lucky's, good steaks.
Great. We'll add those both to the list.
Yeah.
And given your ski record, where do you typically like to go ski?
We have a house in Jackson Hole. So I love skiing in Jackson Hole. Also, the elevation isn't as high there versus Colorado or Park City or Snowbird or anything. So you don't get like altitude as bad. I don't know. Favorite place to ski in North America would be like Revelstoke or Kicking Horse in inner British Columbia, but it's in the middle of nowhere. But I like skiing at Aspen, Snowbird, Alta, Jackson Hole, anywhere.
Great. And then I have to end with, aside from Morton Tech Talks, do you have a podcast or news outlet, magazine, journal that you love to listen to or read?
I read stuff like Cavallino magazine. It's on cars and stuff. So I'm big into cars as well. In terms of my daily news, this is going to like legitly sound ridiculous. I still check my daily news and stocks with Yahoo Finance. And I read CNBC and Bloomberg. I actually find that if you want to know what's going on in the world, you actually should read Fox News and CNN. And then if you just like forget what the article headers say and read the content and take an average, you find that's actually what's really going on in the world.
Well said. Thank you so much again. We really appreciate having you on, and I'm sure our listeners will love the conversation.
Absolutely. Thanks for having me on. I appreciate it.